everyone. Today we will be diving into the topic of accounts receivable management. Before we can go into the details on the management of accounts receivable, let us first define accounts receivable. So, what is accounts receivable? It is the money which a customer owes to the business for the products or services provided on credit. Ideally, a company would love to obtain cash on hand for every service and every goods that's been delivered, but that is impossible unless there is substantial settlement or cash discounts which is offered to the customer as a incentive. It is also really important to take into account the trade practices or the industry practices, which plays a huge role in defining the way and the manner in which the products and services are sold. So that is accounts receivable in an organization. Now, when we talk about management, what do we aim to manage here? So we aim to manage the level of the accounts receivable. It's really important for an organization not to overindulge in offering too much of credit. Of course, if the company is going to be really lenient, um, the, they will attract heaps of customers, but that will happen at the cost of increasing the risk, and also increasing the cost of financing the accounts receivable balances. Because if the company is offering credit to its customers, it is definitely going to be seeking more finance from the banks, and they will need to pay interest and service their debt. So it's really a balancing act. So when it comes to accounts receivable management, there are two key objectives which is pursued by the company. The first objective is to attain an optimum level. It should not be way too high, or it should not be way too low, but it should be the right level. And that right level is achieved through a balance. So there are two key factors to be considered. One is the profit, and two is the cost. So the profit for offering credit to the customers. So, for example, if I run a business and I'm selling water bottles, and I'm selling, let's say, 100 water bottles on credit of 30 days. So, if the water bottle costs $10 each, I'm going to be selling on a credit of $1,000, and for 30 days I will not receive the cash from the customers. The customers are enjoying 30 days period for them to enjoy the credit, and then they pay me the cash after 30 days. So that's how practically it works. And now, as a product owner, as a company owner, I need to decide how far can I allow the customers to enjoy the credit. Is it 30 days or 15 days or 10 days? What's my ability? So I really need to decide and assess my ability. So that's number one. And the second aspect is the cost. So if I am offering a credit of $1,000 to my customers, at what cost am I doing it? Am I overdrawing funds from the banks, or am I taking a loan? If I take a loan, what's the interest that I'm paying on the loan? So those are the elements which we really need to consider, and it's really about a balancing act. So when we talk about accounts receivable, we need to really balance the liability side of things and the profitability side of things. When we talk about liability, there are two elements. One is an element of um, collecting the receipts. So, as I mentioned, I'm selling 100 water bottles, $10 each, at a credit of 30 days credit period. And now I should aim to really collect that $1,000 within 30 days. If it's going to be delayed, then I am at a risk of losing the collection, at the risk of facing irrecoverable debts. And at the same time, if the customer fails to pay within 30 days, what happens is I will end up paying more interest on my bank loan um, for for being able to offer this credit to the customer. So that those two elements. One is the element of collecting the receipts quickly, and the second element is servicing the cost of the debt and minimizing the financing costs. So those are the two key elements which really matters on the liability side of things. And from a profitability side of things, there are two key elements as well. One is the credit period. Let's say while I'm selling the water bottles, if I'm going to be offering, let's say, 60 days of credit, it's going to really encourage more sales. More customers will be drawn to my company because they're going to compare the credit terms that I'm offering as against another company which is just going to be offering 30 days. But when I'm extending the credit period, though the sales increases and the profitability increases, as we just saw on the previous slide, there's always a cost. The liability is impacted. So that's really important. And for a manager, for a finance manager, it's really important to identify the ability, and also remember that there is a trade-off, and that trade-off will be the key factor in determining what's the company's working capital investment. And now, as we've been seeing in the past few slides, accounts receivable is the heart of the business organization, and especially from a working capital perspective. Now, how do we manage it? So, for managing the accounts receivables, usually companies establish what's called as a credit policy. Now, what's a credit policy? So, a credit policy is a way in which the company defines the terms of the credit. So there are four key aspects. The first aspect is the credit worthiness. So the policy will be defined based on the credit worthiness of the customers. And second is the credit limits. What's the limit? What's the extent to which a company can offer? Like, for example, if I talk about my company, I can only offer $1,000. That's my limit. I cannot go beyond that. And similarly, let's say I'm selling these 100 bottles to a customer. It also depends on their ability to repay me. So there is a limit both ways. And thirdly, the third key aspect is the invoice. The invoices has to be sent out promptly, and the overdues have to be collected, because that's really important for the financial health of the organization. And lastly, it is really important to review the credit system and the credit policy. So these are the four key aspects, four key pillars of a company's credit policy. And now there are 5 key factors which influence the policy. The first key factor is the demand for the products. So, yes, we would like to sell water bottles, but what's the demand? Is it winter? Are people really worried about carrying water bottles along with them? Or is it school season? Are all parents really keen to buy more water bottles? So what's the demand? What's the season? What does it look like? So that also defines the credit policy. It's not set in stone. It is fluid. And also, as I mentioned, if I'm offering a credit of $1,000, what's my ability to service the debt or the loan which I'm going to be obtaining from the bank. And the third element, or the third factor which is going to influence the credit policy, is the cost of the credit control. The cost of the credit control refers to the system which I will be maintaining, the softwares which I'm going to use, and the different processes and tools and labor costs which I'm going to incur for monitoring and for issuing invoices, and the overall housekeeping around it. And the fourth factor is the risk of irrecoverable debts. So, what is the risk of me not being able to collect the $1,000? How is it going to impact my operations? How is it going to be impacting my business? So that is a key consideration as well. It's not all a rosy picture. There are risks always involved in business, and how is that factored into the credit policy? That is a key aspect, and practically there are many challenges. And finally, the competitors' terms and conditions. As you know, let's just come back to the water bottle business. I am not existing in monopoly. There's going to be heaps and heaps of competitors. So how am I differentiating myself, and how am I providing an edge to the customers, and why should a customer come to me? So that's again another strategic aspect which has to be considered while deciding on the credit policy of my company. Now, let us unpack on the key aspects of the credit policy. The first one being the credit worthiness. Now, when I am offering credit to my customers, it's really important for me to assess their worthiness, their credit worthiness, because there is a high risk. There's a very high risk of irrecoverable debts. There's a high risk that the customers will not be in a position to repay the $1,000 which I'm offering to them as a credit. And then I will be at a loss, and I might have to close down my business. So proactively, I need to do some analysis, and one of the key analysis is to assess what's the credit worthiness of the customers. So there are two kind of customers: new customers and existing customers. New customers, we need to do the assessment as early as possible, immediately, and for existing customers, we need to do periodical reviews, preferably every year, once in a year. It's important to assess the credit worthiness of the existing customers. Now, for assessing this credit worthiness of the customer, we definitely need information. And where do we draw these information from? So there are sources, reliable sources, and all these sources have their own pros and cons. To start with, the first key source of information to assess a customer's credit worthiness is their bank statement. Now, for obtaining a bank statement on the customer, I need the permission of the customer. I need to sought the permission of the customer, and the statements are quite standardized, and it doesn't provide any extra information for me to make a confident decision other than showing the bank balance. So it is one of the source of information, but it's not a really huge helpful source of information. And the second source of information is the suppliers. The customer might have already existing credits with other suppliers, and understanding their relationship, the customer's relationship with their already existing suppliers, is a huge source of useful information. We can analyze if the customer is genuinely making timely payments, and are there any dangers in offering a credit, and will this customer default. So all those assessments can be undertaken from the supplier's information. So it's quite a stronger um, source of reference for us. And the third source of information for assessing a credit worthiness is the competitors' information. Usually, in some industries, not in every industry, but in some industries, such as insurance, um, competitors usually share the information on their customers, and this will be a great source to analyze the credit worthiness, and and it's quite a strong source of analysis as well. And the fourth source of information is published information. Every company is obliged to publish their annual accounts, and it provides a good overview of the financial position and the liquidity position of the company, and its historical position, and it's not an extremely strong source of information, but it is useful to a great extent because annual accounts are usually audited, and it is proven to be a promising source of information to assess the credit worthiness. And the next source refers to the credit agencies. So there are credit agencies, renowned credit agencies, who publish the financial details of many companies who might be your prospective customers, and also they provide a credit rating for these companies. So it's at a cost. This information is available at a cost, and these credit agencies also produce special reports on request. But as I mentioned, this is going to be an additional cost. And like if I'm selling water bottles for $1,000, I must really need to analyze if I'm going to be paying $2,000 to analyze the credit worthiness for $1,000 worth sales. It's not really feasible. So it's just a trade-off, and it's an expensive option. That's what I would like to say. And the next source of information would be the sales records, the existing sales records, which might show the promptness of paying the existing sales, outstanding sales amounts. This is a good source, but not really strong because it's just going to show how prompt the company is, but it might not really reveal the ability for them to pay my current sales. For example, if I'm going to go and check the sales ledger of my customer who's bought $1,000 worth of water bottles from me, I might be able to gauge as to how they have paid the existing seller, but I wouldn't really be able to understand or estimate their position in 30 days time. Let's say if that's the credit period, I can't really analyze or estimate their position. So it's not futuristic. It's quite it's quite supplementary source of information, but not a very promising source of information. And the last source of information for assessing the credit worthiness of the customer is credit scorings. So credit scorings are analyzed based on indicators such as the ownership, home ownership, or the occupation, or the age, and other family circumstances. If they are just couples, or do they have dependent children? Is it just one child, or two children, or three children? Do they have dependent parents? So what's the overall financial health of the person, if it's an individual? And if it's a company, then other indicators around their financial position and their existing profitability. So there are several permutations and combinations in which the indicators can be analyzed, and based on those, um, a score can be obtained for each of the customer. And there are huge set of softwares packages available in the market, which could be used as a promising tool to assist us in assigning a credit score. And a credit score is a score which is one off, and it's not manipulated by the company. It is something which is assessed independently, and hence it's going to be a reliable source, a strong, reliable source for assessing the credit worthiness of the company. So to sum up, the accounts receivable management uh, is a very delicate balance. It's not a science; it's an art, and a periodical assessment and review has to be undertaken, and there has to be a strong appetite to monitor the credit system on an ongoing basis. And this is a key factor in deciding the company's financial health, especially the working capital health. Thank you for listening, and I hope you found this information useful. In the following videos, I will provide more information on the rest of the three aspects of credit policy. And until then, goodbye. Thank you.